Lisa, we are also joined today by a gentleman by the name of Howard Ward, portfolio manager and director of growth equities at Gamco. That is Gabelli Asset Management, for those not in the know. This is a big firm with how many billions under management?
36.
36 billion. All right, director of growth equities. So you see value in the market right now, don't you?
Yes, actually, the market is really at its lowest price earnings ratio since 1991. And in 1991, the 10-year Treasury was yielding 8%. Today, it yields 2.2%. So stocks are really pretty cheap, especially when they're compared to bonds.
In other words, if you went back then when rates were so much higher versus now rates are so much lower, you're getting better growth. Ironic. It's almost a double whammy. In theory.
In theory, you're right. And of course, with the lower interest rate, the present value of those future earnings should be greater.
Bingo.
So price earnings ratio should be much higher.
You should be willing to pay up.
You should be willing to pay up for stocks today. But of course, people are very afraid. Whether it's the European debt situation or our own economy, there's been a real fear trade involved the last few months.
People are talking about GDP estimates, gross domestic product, being higher on Thursday when it comes out. What do you think?
I think so. Yeah, actually, I think we're actually seeing the economy accelerate in the third and fourth quarter. First half of the year was so depressed by the Japanese supply disruption, by extreme weather, by the spike in oil prices coming out of the Arab Spring, that it really dampened growth. Sub 2% growth in the first half of the year. We're going to be looking at 2.5% growth, maybe better for Q3, and I think Q4 will be also plus 2%.
So in other words, you think what happened with Caterpillar is suggestive of more to come?
Absolutely, and it's not just Caterpillar. The earnings that have been coming out have been much better than expected. Now, that's not unusual. I mean, typically companies
They usually do.
They usually do. But these are solid. There's no sign of an imminent recession right now.
Okay, we're going to get into some of your picks after we get through these numbers in the closing bell. Let me give them to you right now. Looks like the Dow is going to finish up about 106 points. There's still a few prints coming in, but over 100 points bottom line. The S&P up 1.3%. That is up at 1254. That is well above all those resistance levels that the market couldn't break through. So we have broken out on the S&P. And finally, on the NASDAQ, where all those tech stocks lives, they are up about 2.3%. Lisa, I could keep on talking till the cows come home, so I better let you in here.
Yeah, I'm going to jump in. Let's talk a little bit. Being in the growth area obviously has been tough for performance. Are there particular stocks that are a little bit more defensive in that space that you're looking closely at right now, or that you'd say don't get into it right now?
Well, Lisa, first of all, as I mentioned to Adam, I think the entire market is very viable at this level. However, for investors that need income, and there are many investors that need income, and for investors who do not like the volatility that this market exhibits, and it exhibits a lot, then I would really steer you towards consumer staple stocks that have dividend yields of 2.8 to 4%, pretty steady earnings growth of 9 to 13%, global business franchises, and pricing power. These would be companies like Coca-Cola, Pepsi-Cola, Procter & Gamble, and Colgate, to name several.
Hey, by the way, Pepsi, there's been talk of maybe splitting this company up, right? Corporate divorce, we've seen a lot of that. Marathon,
right.
Conoco, ITT, take your pick.
Yeah.
Any chance they split Pepsi?
I don't think there's any chance of that near term. I think that's a longer term possibility. If they fail to execute and don't get the kind of revenue and earnings growth that is expected of them over the next year or two, then we'll talk about that. But it's not going to happen anytime soon.
All right, you like consumer staples. You also tell me you like oil. Give me a couple of names that you like and why.
Yeah, well, first of all, I like oil in general because as fear of recession recedes, and we're seeing that today, the price of oil goes up. And a lot of the oil stocks are, of course, leveraged to the price of oil.
And they got crushed.
And they got crushed during the whole summer sell-off. My favorite right now, Continental Resources, ticker CLR. They really discovered the Bakken Shale in North Dakota. They have about 40 years of drilling to do there. It's one of the higher growth names in the E&P world of energy, and I think that would be a good one. It's still down 25% from its 52-week high.
And by the way, what's their cost to bring oil out of the ground? Oil's trading at 90. What's their cost?
I don't know. I'd have to look that up for you. I don't know that.
But it's mid-60s, 70s. Is that a fair estimate?
You know what?
On an operating basis?
It probably is, but I don't know. It's probably cheaper than that.
All right. Talk to me about EOG.
EOG is another company very leveraged to the price of oil and gas. It's about 50-50 between oil and gas. Their big property is the Eagle Ford Shale down in Texas. And again, they were one of the very first movers really discovering that Eagle Ford Shale, transitioning the company away from its natural gas bias that it's had historically towards oil, where they think there's going to be better pricing in the years ahead. And I think this is a company that's going to have one of the best growth rates in the energy world for the next 5 to 10 years.
Let's switch topics here and talk a little bit about technology. That's another sector where you have a number of picks you like.
Yes, and of course, these are not unfamiliar names to anybody that follows the stock market, but I think they're very exceptional values today. I'm not going to surprise anybody if I recommend Apple Computer, but let me just point out that this stock sells at 11 times earnings, which is a discount to the market, which is about 12 times earnings, and that includes the $80 billion of cash that they have on the balance sheet. So if you strip that out, you're really probably paying more like 9 times earnings for this company, and it's got a lot of growth ahead of it. I'd also like to point out Qualcomm. Qualcomm makes the chips that go into most of today's modern 3G and the future 4G cell phones. Qualcomm chips are now used in the new iPhone 4S, which is a first where they're providing the primary chips for that phone. So Qualcomm is a way to play mobile telephony without betting on any particular brand. And this is a stock at around 15 times earning, which I think is a steal.
You know, Howard, I got to ask you about Microsoft, because Microsoft has been dead money for 10 years, been sideways. I know you like it, pays a dividend, but I had a conversation today with Bob Rice of Tangent Capital. He said Microsoft is actually a cloud play. Do you subscribe to that?
Yes, Microsoft, first of all, this is a stock at 9 times earnings. So 9 times earnings with a 3% dividend yield, you don't have to exhibit a lot of growth for this equation to work for you. Microsoft is a cloud play. It's not getting any respect for that in the market today, but it is going to be a factor in all elements of the cloud. And in addition to that, you know, you've still got a company with 80% plus gross margins that dominates the software business. And so, you know, is it a perfect company? No, but that's at 9 times earnings. It doesn't have to be.
All right, another ask you, Howard, Netflix. Do you have a position?
Do not have a position. Never have. A distributor of content. You know, they had a terrific product when they were mailing you the DVDs at home. I mean, that worked out really well for them. But as business has migrated to the internet, business model really seems to have taken it on the chin.
In other words,
it was an extreme momentum stock. And
with ultimately no product, just a facilitator of services.
That's right.
Not unlike a Groupon, and we know that the valuation of Groupon's gotten tapped.
I think that's ridiculous, too.
What do you think of earnings in general thus far?
Very good. Hard to argue. We're going to have a record year for earnings this year, and if we don't have a recession, and yeah, that's a question mark for the next year, but if we don't have a recession, we'll have record year earnings next year as well. $96 of earnings for the S&P is what we're looking for this year. If you put an average multiple of 15 on that, you get $14.40 on the S&P. That's up 15% from here.
Okay, fantastic. We appreciate your joining us. Always good to have you. And a value guy with stock picks, Howard Ward, yes, of Gamco Investors, manages $38 billion. All right.